Welcome to the Colorado Real Estate Leaders Podcast, brought to you by Trailstone Insurance Group, bringing you interviews with Colorado's best real estate and mortgage professionals, empowering you to understand the current trends in the housing market so you can make the American dream your reality. Enjoy today's episode.
Well, it's a great day in Colorado, and welcome to the Colorado Real Estate Leaders Podcast. Today we have with us Jason Evans, who's a mortgage loan officer with M2 Lending Solutions. Jason, welcome to the program.
Hey, thanks guys. Appreciate it. Glad to be here.
You are welcome. Give us a little bit of your background. It's always interesting to me to hear how people got into the industry that they're in. So what led you to the mortgage industry?
Oh boy. Truth be told, back in 2007, 2008, I was in the restaurant industry. I was actually a server, thinking, I was doing pretty good. I was in my early mid-20s. Market crashed, realized that, income is explicitly tied to, folks' dispensable income, right? So I had to find a big boy job. And then I started with US Bank. I stayed there for like 9.5 years. Became a licensed banker, with investments and whatnot. I wanted to shake it up. And so mortgages actually kind of caught my eye, and was looking around, and, Chris here at M2 is actually our owner proprietor, but he's not just the owner proprietor. He's also a great leader and mentor as well. So, I couldn't ask for a better situation, to be quite honest. So, mortgage, it just kind of speaks to me. I'm very analytical and numbers driven, so it just kind of makes sense. I'm also good at sales and with people, so putting two and two together,
That's awesome.
Yeah, and being a server, you learned how to serve. So I'm sure we're going to talk about that here in a minute. But talk to us about the market conditions. Things have been changing a lot in the last 6 months.
Yeah, that's a way to put it. Kind of roller coaster rides. From April until now, we've seen obviously an increase in mortgage rates, pretty much doubling, right? Though after every time the Fed meets, something that we should note is that most of the time actually does, well, at least this year so far, has done a service where rates have actually come down after the Fed's meeting. So just by a little bit, but that's how it works. Some of the things that folks have been trying to look at in regards to navigating these waters is, adjustable rate mortgages, 2-1 buy downs, even VAs and FHAs, just to kind of give a little bit more on the debt to income ratio side of things. So they're all kind of, solutions to the individual's certain situations, but primarily the market has definitely pushed some buyers out. But what's actually kind of staggering or interesting to know is that first-time home buyers are still making up about 30% of all purchases, which is still about roughly the same as it was this time last year. So they really haven't dropped off the market. The folks that really have dropped off are, those buying a second home or their second home or another home kind of thing. They're moving on up or want to just, they don't have to move. They're already owning kind of thing. Investors actually this last month in August have picked up by a couple percent too. So it's just, I think the rates, here's the thing about, mortgages and rates. And one thing that I've learned so far working with Chris is that, you're gonna get in when you can. I mean, just about anybody in mortgage or in real estate is going to tell you, when can you afford a mortgage? When can you afford to buy a house? Well, when you can, it really shouldn't be based off of rates. Okay. If you can qualify under the current rates, we expect, especially with the way that the economy is heading right now, should be getting better here in the next few months by the beginning of 2023 or so, as far as rates are concerned. And so the idea is that if you can get it now, you can always refi later, kind of thing, to help save some money and stuff. But ultimately,
the insight.
Yeah, and ultimately it's up to the customer as far as what kind of monthly payment they're comfortable with. Like some folks, they could be approved up to $4,000 a month, but if they really are only comfortable with 2,500, well then, that takes a little bit of finesse, a little bit of creative thinking on how to get them there. But sometimes that's extra down payment, or just maybe not getting that new construction or turnkey house kind of thing. Maybe it's a little bit more of a fixer upper or something. So,
Hey, Jason, you mentioned 2-1 buy down. Talk a little bit about some of the ways and strategies you educate your clients on, because I think that some people coming out of the 2008, 9, 10 mess back in the day remember volatile mortgages and risk. So how do you talk to your borrowers about maybe getting something that can lower the payment now that can go up?
right. Yeah. And that's a great question. I think the main point for those types of situations is that these individuals need to 100% understand what it means, what they're going into. We don't want, a year or two down the road for them to come back to us and say, hey, what kind of loan did you guys give me? What is this? So it really needs to be crystal clear right from the beginning. Hey, this is how it's structured. This is how it works. This is a game plan. 2-1 buy downs are not adjustable rate mortgages, but they act somewhat similarly, right? So both of them have the smaller payments at the beginning, and then they kind of raise a few years later. For the 5-year, 7-year, 10-year arms, that's the term. You get a 7 or a 10-year fixed rate, and then at the end, after that, it starts increasing pretty exponentially. So the most important piece of this puzzle is to make sure you have that conversation with the customer and have the conversation in regards to what's the game plan.
What's their plan?
Are you moving out within the next 3 years? Maybe it's somebody that's like a traveling nurse or something. They're contracted here for a year and a half, and they just wanted to own, and then they're going to sell it later, or exactly kind of what I was talking about earlier. Their plan is to 100% refinance in the next year or two, and they can afford the 2-1 buy down or the adjustable rate mortgages for right now. And the idea is to refinance in the next 3 years or something like that. You know what I mean?
If the rates come down, because there's no way to know. So, if someone said, I plan to be in the area for 3 years, well, maybe you talk to them about a 5-year period where the rates are staying the same before they can go up, just for that comfort level.
Right. 100%. Yeah. I mean, if I had the crystal ball, I wouldn't be in my position right now. Probably,
you'd be playing the stock market.
Oh my gosh. Yeah. And winning. So the idea is that we don't have the crystal ball, but I pretty much religiously watch MBS Highway, which is a Harry Habib kind of deal, and he's a market expert. We're attached to Mortgage Market Guide, Mortgage News Daily, that kind of stuff, and just keeping the pulse on the market. It's one of those things that a lot of market experts are believing that because there's a lot of folks that believe that we're in a recession already, that just the feds haven't really officially claimed it just yet, because of, this, that, or the other reasons, primarily, unemployment. But, if we're already in the recession and mortgage-backed securities are set for, a higher increase in purchases, that means that the yields are going to come down, just simple supply and demand, where, these mortgage-backed securities don't have to pay as much in yields if folks are kind of flocking to them in the times of recession, right? So, a lot of experts are thinking we could even see the fours again in the next year or so. But, like I said, there's no guarantee that that's going to happen. So it's more or less these folks that are going to be here for, like you were saying, maybe a year or two kind of thing. Like those are really those types of folks. I mean, you could always refinance back into it, but that's kind of a hassle and wouldn't really
costly. So you have to be careful.
Right. Yeah. And you don't want to basically take advantage of the customers to keep doing loans for them just because they're in a 2-1 buy down. Like it's that's not how we do good business. We do good business by setting them up correctly from the beginning, and that's the right way to do it. That's how it should be done. Not just here, but anywhere.
You got it. Hey, so you mentioned first-time home buyers. What are some of the ways that you find first-time home buyers are coming to you and asking questions that are like, wow, they must understand this? Maybe it's something that they didn't think to ask you, but boy, they need to understand this point and this point before moving forward in the process to help protect them and help educate them.
It's a good question. I could probably spend a lot of time on that one. One of the biggest things I think that folks really need to understand as a first-time home buyer is the need to make sure when you buy the house that you also have a little bit extra when you buy the house. So like, don't buy the house when completely depleting your capital, Also a big stigma I feel like here, especially in the Denver market, is a lot of folks want to be using CHAFA, which is a local down payment assistance program. There's certain situations that call for it for sure, but ultimately we believe that, at least here at M2, we can provide better solutions than that as far as investment wise. I shouldn't say investment wise, I guess more of an investment like mind, saying, hey, maybe your money's better served doing this instead, kind of thing. Right. So some of those situations or some of those calls that we make are with, bottom line being in mind for the customer.
What's an example, like you mentioned, the down payment assistance? To me, that sounds like a great thing. You give me a grant or down payment. What are some of the downfalls of that people experience?
The biggest downfall would be the rate, to be quite honest.
Okay.
So, like, for example, today, with where rates are at today, I should say, where rates are today, we're right around a 6%, right? So with CHAFA, they're at 6.5. Okay, so that just giving you an example, 9 times out of 10, CHAFA is always more expensive than where the current market is. That's the point I'm trying to make here. And they'll give you 4% down payment, and that's what we can do. Which, by the way, only lenders can work with CHAFA. So if you're looking for down payment assistance, you really can't find that with brokers. CHAFA doesn't work with brokers; they work with lenders. So
direct lenders. Okay.
FYI, yeah, a little sidebar. But with CHAFA, they have the higher rates, and then they'll give you 4%. But right now, to get that 4%, it's a grant. So you're actually paying that thing back. It's a silent second. So you're not actually paying it back right off the bat, and you're not paying interest on it. But eventually Colorado gets that money back in the form of either a refinance, or if you sell the house, it comes off the top. Or if you pay off a loan, then all of a sudden you owe whatever you quote unquote borrowed from the beginning, right? So sometimes when folks, especially first-time homebuyers using CHAFA or down payment assistance programs like that, they come to us and they say, hey, we want to do a refinance. Well, some of their maybe cash out refinance is eaten up by that, and they don't expect that, and it can be a surprise to them, So that's the downfall for CHAFA. But in many situations, it's really helping. Like, to give you a quick example, we had a client not too long ago get under contract for a $600,000 home, and they only had to put about 10 grand into it.
Wow.
So it's a pretty powerful tool for sure. But ultimately their situation specifically, they're going to look at refinancing here in the next year or two when rates come back down, because like I said, CHAFA rates, they do what they want. You could have a 620 credit score, or you could have an 800 credit score. It doesn't matter. You're just going to get the same exact rate kind of thing.
So you mentioned investors. Talk a little bit about the type of investors you work with. Are they buying single family residents to rent out? Do you do, fix and flip kind of loans? Because I know there's a lot of variety that people could consider.
Yeah. And thank you for that. We are a traditional lender. So unfortunately, we're not doing fix and flips. We're not doing any sort of hard money lending, things like that. When I was really mentioning the investors is more or less, folks that are just basically buying houses right now. How hot is the market kind of thing. Obviously it's cooled down quite a bit, but the best way I can describe it, comparatively speaking to, this time last year, even, January, February of this year, we're looking at basically getting off the highway, and now we're in the suburbs. So we're still like moving forward. We're still selling houses. The inventory's opened up just a little bit, but not as much as people like to think. Because if you look at the actual numbers, at least August numbers were 1.26 million units or something like that. But about 44% of that are houses that are under contract. So then you have to take 55% of that, and that's actually the actual inventory of the U.S. kind of thing. So sometimes context is not always there when you see those numbers, those kinds of numbers, if y'all are looking for them. But it's one of those things that, we just got to understand. Inventory is still super tight. So
what should a investor think about for down payment? Like you mentioned, for a first-time home buyer, you can get some pretty low down payment or grants. Is an investor going to be up against 20% down, 25, or is there some lower down payments that you work with?
That's a great question as well. With going, conventional wise, because we deal with primarily qualified mortgages, but with jumbos and we can actually do bank statement loans, but primarily with conventional loans and qualified mortgages, you're looking at minimum 20% down for like either basically an investment property. A second home, you could get away with 10% down, but we do recommend, if you're doing an investment property, we do recommend 25% down. And if you can get that extra 5%, it could mean the difference between, like a half to maybe even 3/4 of a point. So it's very, very important to explore that opportunity as well with these investors.
That's interesting, because I would think that when you put more down as a individual buyer buying, your primary residence, you could potentially avoid the mortgage insurance. So that's a driver. But at 20% down, that's still a lot. But you're saying the difference between 20% down and 25, which is not a big swing, could get like an extra notch lower on the interest rate. So that would be a neat calculation to show, if you did this, here's the payment. If you did this a little bit more, here's the difference. And that could be a nice comparison.
Yeah. And if you don't mind, just real quick, piggyback on the percents down. For primary, if you're a first time home buyer or second time home buyer and you're trying to buy something as your primary house, and you're looking at putting 20% down to avoid the mortgage insurance, fun fact here, actually, it's something that not a lot of people know, is that 15% down, you're probably actually going to get a better rate and you're going to be able to save some money. And what I mean by that, with my experience as an investment, licensed banker, I should say, not necessarily investment banker, but as a licensed banker, I have that investment mindset, right? So what I'm trying to say here to you guys and everybody else that's listening is that if you put 15% down, let's use 500,000 as an example. You use 15% down, that's 75,000, right? Versus 100. So what you can do is you can keep 25,000 in your pocket, pay about, if you have a good credit score, your mortgage insurance is probably going to land anywhere between $50 and $70 a month. But let's say worst case scenario, it's 100. Okay. So you pay, usually, unless you refinance out of it, the earliest you can actually get out of mortgage insurance with your current mortgage, you'd have to get an appraisal and all that jazz. I'd have to do all that. And I can go into that if you want me to. But basically, you have to keep it at least a minimum of 2 years. Some investors, what I mean by that is like mortgage servicers require a minimum of 18 months, but most require 24. So let's pretend if you're paying $100 a month for 24 months, that's $2,400. So what I'm trying to say here is that if you can keep 25 grand in your pocket, because that's the extra 5%, you're trading $2,400 to keep 25,000. And then you can turn around and invest the 25,000 in places to not lose any money. So you're actually leveraging mortgage insurance at that point to help you out.
While staying liquid, which gives some safety.
Options and safety. Yeah, 100%. So, mortgage insurance has such a bad rap And in some cases, it absolutely does, especially with FHA. But with conventional, you can actually kind of make it work for you.
Is mortgage insurance based on credit score? So the better your score, the lower the rate is, or is there a correlation at all?
Yeah, 100%. So it's that plus also the loan to value as well.
Yeah.
So if you have great credit, but you're only putting 3% down, you could be paying, $150 a month. But if you're putting, 10% down, you could be paying 100, and you got good credit.
So it's sliding scale. So kind of getting back to your example of if you have that kind of liquidity that you could put less down to stay liquid, you probably potentially have a good credit score that could get you a little bit better. So don't just hear the word mortgage insurance and think, oh, people told me PMI is bad. Put in the calculation and look at the scenarios and see what might benefit you. And that's where someone like yourself can sit down with someone and say, here's option 1, 2, 3, and what feels best.
And with that, 20%, like what kind of got me on that little tangent was that with 20%, banks look at that and say, hey, there's no mortgage insurance on here. So that is the bare minimum that you guys can put down without any mortgage insurance. So what if Mr. and Mrs. Borrower can't pay it back? Well, what happens to that? We don't get paid back now. We got to go to foreclosure and somebody else has to buy it. So that's a big, huge hassle. They don't feel warm and fuzzy. So they're going to give you actually a worse rate than someone with 15% down. Okay. Because they have that mortgage insurance. They have that warm and fuzzy. You see what I'm saying? So I've seen about 0.25% difference in rates just between 15 and 20%, and 15% being a better rate than 20.
I love the education, and our listeners will appreciate that too.
Yeah, I'm huge on that. I've always been huge on that. When I sit down with my clients, even when I was at US Bank, was just let's make sure that these folks really understand kind of what's going on. And sometimes I have a tendency to talk, so it can be much for a lot of people. So maybe small doses is good, but
that's all part of relationship building. Right. I mean, for real, that people want to talk to someone that's friendly and personable, but then when you layer that in with good advice and tangible, like here's this report, here's this number that option 1 is 10%, all these things we're talking about, they can see it clearly.
Yep. It's important.
Excellent. Well, Jason, I think this has been spectacular. Thank you for coming on. You've really given us some great perspectives. If someone is listening to this going, hey, what could some options be for me? What's the best way they can reach out and connect with you?
Oh, man. So, yeah, you can always call me directly on my direct line at work. The phone number is 303-847-4221. Email is just as good. And did you guys say you have that, or?
We will put your direct website link right in the show notes. So if you want to give out email and phone number, that is wonderful.
Perfect. Yeah. So the email would be J Evans, kind of spelled how it sounds, but JEVANS at M2 Lending. That's M as in Michael, the number 2, lending.com. And those are probably the easiest ways to get a hold of me.
Super. Well, thank you. Yeah. Thank you. That is really good. And thanks again for coming on. It was a real pleasure talking with you today.
Yeah. Thanks again for all of you guys' questions and having me on the show, to be honest. So
You're welcome.
Very, very humble and very excited to be here. So thank you.
Thank you for listening to the Colorado Real Estate Leaders Podcast, brought to you by Trailstone Insurance Group. To learn more about the topics mentioned on today's show or listen to past episodes, visit www.coloradorealestateleaders.com.